So let's start with question number 1. It states, Miss Purna purchased a residential house from her friend, Miss Leena. That is, Purna is the person who has purchased. Leena is the person who has sold. Therefore, for Leena, ideally, we have capital gains. So the person who has sold will have a capital gains. So at 20 lakhs in the city of Coimbatore on 17th December 2020. The value determined by stamp value. The value determined by the stamp value is just a minute. I hope you are able to see my screen. Okay. So the value determined by the stamp value is 28 lakhs. So Purna, Leena has sold at a price lower than the stamp value. Lower than the stamp value. The sale price is 20 lakhs. They are sold at a price lower than. Therefore, section 50C will come into picture. Miss Leena has purchased in 2015 for 5 lakhs. So Leena purchased it in 2015 for 5 lakhs. So purchased in 2015, sold in 2020. So Leena held for more than 24 months. More than 24 months. Therefore, for Leena, it would be a long-term capital gain. Leena, it would be a long-term capital gain. Then again, Purna, who purchased on 17th December, now sold it on 26th February for 30 lakhs. Purna purchased on 17th December, sold it on 26th February, less than 24 months. So for Purna, it will be a short-term capital gain. There is also one more part that we need to understand. Purna purchased at a lower than stamp value. Purchased for 20 lakhs when the stamp value is 28 lakhs. Stamp value is 28 lakhs. So this would lead to gift under section 56 received for inadequate consideration. Received for inadequate consideration. Miss Purna sold this for 30 lakhs on 26th February 2021. So what is the question? The requirement. Determine the above transactions for assessment of Miss Purna and Miss Leena for 21-22, assuming the value of stamp value in the second case was not more than the selling price. Right. Let's go ahead. Understand this particular case. Let's go ahead and understand this particular case. I'll just project my Excel also so that you will be able to see it properly. Just give me a minute. I'll just project my Excel. Hope you are able to see my Excel also now. So I will take both the screens simultaneously so that we will all be able to understand this. Now, please stop me if at all you are not able to see my Excel. So I have made it a little bit bigger so that you will be able to see the font also very clearly. Right. This is the font that we will be having. Please stop me if you are not able to see. Right. First, let's understand for Leena. We'll understand for Leena. So Leena has sold it for 20 lakhs and the stamp value is 28 lakhs. So what is section 50C says? Section 50C says you will compare the selling price with stamp value. Whichever is higher, that would be considered as full value of consideration. Selling price, understand friends, selling price we have got 20 lakhs. I'll take SP here is selling price. SP here is selling price. Stamp value. SV na stamp value. SV means stamp value. Stamp value is 28 lakhs. So you will actually compare 110 percentage of. So if you go back to section 50C discussion that we had, we'll take 110 percentage of selling price, compare with stamp value. These two, whatever I have highlighted in yellow now. These two you will compare. You will compare what is 22. 22 is 110 percentage of selling price, and you will compare with the stamp value. Now stamp value is more, therefore full value of consideration would be 28 lakhs. Full value of consideration would be 28 lakhs. Again, going to this question here. If at all you understand this once again, it is sold for 20 lakhs. The stamp value is 28 lakhs. So you will take 28 lakhs. You will take 28 lakhs as full value of consideration. Now, this was sold. Lena sold on 17th December 2020. Lena sold on 17th December 2020. Purchased. See here, friends. It was purchased by, see, Lena had purchased on 28th December 2015. 28th December 2015. See, around 5 years. Around 5 years. We are not bothered about. It is more than 24 months. More than 24 months. So for long-term capital gain, it will be considered as long-term capital gain. Why? For immovable property, the holding period should be 24 months. Immovable property, the holding period should be 24 months. Here, it was held for more than the 24 months. Therefore, for Lena, it would be a long-term capital gain. It would be a long-term capital gain. But in this problem, they have not given you, see here, they have not given you CII, cost inflation index. So we will simply say cost of acquisition is 25, purchased for 5 lakhs, sorry, purchased for 5 lakhs. So long-term capital gain will be 23 lakhs. We will say within brackets, subject to indexation. We'll say within brackets, subject to indexation. Now, let's read what we have got here. Tax treatment in the hands of seller, Miss Lena. 50C provides that where the consideration received or accruing as a result of a transfer of capital asset, which is land, building, or less, or both, is less than the value adopted or assessable by an authority of state government for the purpose of stamp duty in respect of such transfer, the value so adopted shall be deemed to be the full value of consideration. Shall be deemed to be the full value of consideration for computing the capital gains. The third proviso provides that where the value adopted by the authority for this purpose does not exceed 110 percentage. That's what we did. Does not exceed 110 percentage of the consideration on account of transfer. Then the consideration so received shall be deemed to be. Now it exceeds 110 percentage. Therefore, stamp value would be full value of consideration. So in the instant case, Lena sold a residential house at Coimbatore to her friend Purna, where the stamp value is 28 lakhs. Therefore, stamp value shall be deemed to be the full value of consideration. Therefore, long-term capital gain arising to Lena will be 23 lakhs. So 28 minus 5. However, it will be subject to indexation. Subject to indexation, that point we have now added. The capital gain is long-term since the period of holding of residential property is more than 24 months. Right? Hope you are all able to understand this particular part. This is not the only part here. Let's again understand what happens to Purna. Let's go ahead. Now for Purna. Section 56, subsection 2, subclass 10 would be applicable. What is it? Gift. Friends, if you all you recollect, friends, we said the gift there are 3 aspects: cash, immovable property, other properties. Here very clearly it's a residential property. Therefore, immovable property. Immovable property has got 2: nil consideration inadequate consideration. Nil consideration and inadequate consideration. Here it's a case of inadequate consideration. Why do we say it is inadequate consideration? The reason is stamp value. Stamp value is 28 lakhs. Consideration they are given is 20 lakhs. See, stamp value is 28 lakhs. Consideration is 28 lakhs. 20 lakhs. Stamp value is 28. Consideration is 20. So inadequate consideration. So for Purna, gift would be 8 lakhs. Under section 56 to subclass 10. 56 to subclass 10 for Purna, gift would be 8 lakhs. How did we get that? 28 lakh minus 20 lakhs. Friends, please understand, all are in lakhs. I am not typing 28 lakhs. Fully I am not typing, I am saying 28. So it's all understood. So we are going more on substance. I know I give only 28. Is it 28 rupees? No, it's only 28 lakhs. I am giving you only more on substance here. Again, friends, if at all you have got doubts, please stop me. Please stop me. They understand the requirement is you all understand the issue, not about completion. That is what is requirement. So it is 28 minus 20. You will end up having 8 lakhs as gift for Purna. Right? Then Purna sold. We'll come back to Purna sold. We'll only till understand until this point in time now. Now, tax treatment in the hands of buyer. In the hands of buyer, Miss Purna. The taxability under section 56(2) subclass 10 includes within its scope any immovable property, being land, building, or both, received for inadequate consideration. As per section 56(2)(10), where any immovable property is received for a consideration is less than the stamp value and it is more than 50,000. Yes, the difference is more than 50,000. Then it will be taxable in the hands of the recipient as income from other sources. The provisions of section 58(2)(10) will be applicable since the difference is more than 50,000. Yes, see here, 28 lakhs minus 20 lakhs, it's 8 lakhs, more than 50,000, more than 50,000. Therefore, 8 lakhs being the difference between the stamp value and the actual consideration would be taxable in the hands of Purna under income from other sources. So for one transaction, two taxability. Taxability in the hands of Leena as long-term capital gain, for Purna as gift. As gift, this is one transaction where Purna purchased from Leena. On this transaction itself, you have got a taxability for the seller, you have got a taxability for the buyer also. Now, let's go back and understand one more part in the question. Now, Miss Purna sold the house for 30 lakhs on 26th February 2021. Now, if the recipient has paid tax, if the recipient has paid tax under section 56, then cost to the assessee would be stamp value as on the date of gift. Recollect. We discussed this separately. We had a table where we discussed assessee paid tax, assessee did not pay tax. Assessee paid tax, assessee did not pay tax. So here is assessee paid tax. Therefore, stamp value would be the cost of acquisition. 49 subsection 4. Holding period of previous owner. Holding period. HP here is holding period, not horsepower or hire purchase. Holding period of previous owner should not be considered. Holding period of the previous owner should not be considered. Holding period of the previous owner will be considered only for transactions covered in 49(1). 49(1). This is not 49(1). This is 49(4). Why 49(4)? The recipient. Who is recipient here, friends? The Purna. Miss Purna has paid tax at the time of gift. Purna has paid tax at the time of gift. Therefore, it would be taxable. It would be taxable under section 49 subsection 4. It would be taxable under section 49 subsection 4. So, cost of acquisition would be stamp value as on the date of gift. So, as on the date of gift, what is stamp value? 28 lakhs. It has been sold for 30 lakhs. So, full value of consideration would be 30 lakhs. Then, cost of acquisition is the stamp value as on the date of gift, which is 28 lakhs. Here we will have short-term capital gain. Why? Please see here, friends. Acquired in December 2020, sold in February 21. Not even 1 year. Not even the same year it has been less than 24 months. It is held for less than 24 months. Therefore, it will be short-term capital gain. How much? 2 lakhs will be the short-term capital gain. Right. Now, let's go ahead. Understand this part that is there. As per section 49 subsection 4, the cost of such property will be the value taken into account for 56 students. What is the value? Stamp value. Accordingly, 28 lakhs will be the cost of acquisition. Therefore, on sale of flat, 2 lakhs would be taxable as short-term capital gain. How? 30 minus 28. Since this is a case covered under 49.4 and not 49.1, the holding period of the previous owner will not be considered for determining the capital gain. Will not be considered. Holding period of the previous owner should not be considered. Right. This is what we have got for question number 1. There's no doubt. So let's move on to question number 2 that we have got. This is again a Supreme Court case that we have discussed. At 2 places in our capital gain discussion itself. At 2 places we have discussed this Supreme Court case law. One at the time of discussing the exemptions, 54B exemption, we discussed this. We also discussed this at the time of 45.5. 2 places we have discussed this Balakrishna Supreme Court judgment. This question is based on that. Anyway, let's understand what is this question is all about. Now, Mr. Krishnan owned vast area of agriculture land in Tamil Nadu. The state government acquired the property for development of a technopark. State government acquired now what is this? Compulsory acquisition. So Mr. Krishnan was awarded 15 lakhs. What is this 15 lakhs? Full value of consideration they have determined. However, Krishnan was not satisfied. Aggrieved by the amount, he initiated the negotiations with collector. Further, to which compensation was fixed at 35 lakhs. So now, Krishnan started negotiating with the collector. He went and talked to the collector and said, so look, the area is huge and you are giving me only 15 lakhs, which is not ideal. I want more, and he ended up with negotiation of getting 35 lakhs. Here what is happening? It is an agriculture land which is compulsory acquired. Agriculture land, if it is compulsory acquired, then what happens? Section 1037, you will have an exemption. Section 1037, there will be an exemption. Right? If there is a agriculture land acquired which is compulsorily acquired. Now, Mr. Krishnan claimed exemption from capital gain under section 1037 since the transfer of agriculture was account of compulsory acquisition. The officer contended that the exemption under section 1037 would not be available in the case as it was not a compulsory acquisition but a voluntary sale since he received higher compensation due to negotiation. What has happened? Here he negotiated. Because he negotiated, he got a higher amount. So assessing officer said, you negotiated. Because you have negotiated, it will not be considered as compulsory acquisition. It is a voluntary sale. If there is a voluntary sale of urban agriculture land, then it will be taxable. 1037 you cannot claim. Right? Now, what is Supreme Court Balakrishna judgment says? Just because there is a negotiation, it will not lose its originality as compulsory acquisition. They have acquired compulsory. What I went and talked is only about the consideration. I only talked about a consideration. They did not give me the option. Did they give an option whether to take or not to take? No, they did not give an option. They came and took over my land. That's all. They came, took over my land. I went and talked and determined the negotiation. So Supreme Court in the case of Balakrishnan, where we discussed, as I was saying, 2 cases we discussed that. Right. We have said that it will be eligible for exemption under section 1037. Right. Let's read. Examine whether the claim for exemption is tenable in law in this case. The issue under consideration is whether higher compensation on account of negotiation would transform the character of compulsory acquisition into voluntary sale. I am going and negotiating. Just because I am negotiating, will it change from compulsory acquisition to voluntary sale? Is the question. Is the question. I'm going and negotiating. Will it change from compulsory to voluntary? Is the question. So that to deny exemption under section 1037. The issue came up before the Supreme Court in Balakrishnan versus Union and others, 391 IDR 178. In examination friends, if you write a Supreme Court case law, in the case of Balakrishnan, that is sufficient. You don't need to write all these citations and all, not required. Examination, not required. The Apex Court of Supreme Court, observed that the acquisition was initiated under Land Acquisition Act. Land Acquisition Act itself is clearly compulsory acquisition. Assessee enter into negotiations only for securing the market value without going to the court. Otherwise, what will happen? We will have an enhanced compensation. Right? Either you negotiate with the government or go for enhanced compensation. Merely because the compensation is agreed upon, the character will not change. This is important terminology. From compulsory acquisition to voluntary sale, it will not change. So the court also drew attention to the recently registered right to fair compensation and transparency in Land Acquisition Rehabilitation Act. Right, section 96 we discussed, which empowers the collector to award the consent to the parties. Despite the provision consent, the acquisition would continue to be compulsory. Accordingly, the Supreme Court held that the proceedings were initiated even under Land Acquisition Act, even the compensation is fixed and negotiated, it would remain as compulsory acquisition. Applying the principle of Supreme Court, the claim of exemption is, in the case of Mr. Krishnan, is tenable in law. Tenable means it's agreeable. It is allowed. It is allowed for Mr. Krishnan. So there is nothing to compute and all here. This is what people call as theory. We cannot call as theory, right? This is what we are writing the relevant provisions of the Act. In the Act, we don't have anything. Therefore, we are writing the case law. If there is a relevant provision, we have to write the relevant provision. If the relevant provision is not there, then what we will do? We will write a case law. We will write a case law. So here we have got a case law, Balakrishnan, and based on the Supreme Court judgment, we are doing this. Now, moving on to. This is a case of computation under section 112A. Computation under section 112A. What is 112A? We will take an Excel to solve this. We will take an Excel to solve this. Again, we have done at least 5-6 cases of at least 5-6 cases. My memory. We have cases different combination and permutation. We have done. What is 112A? 112A is long-term capital gain on sale of shares or securities where STT is paid at the time of purchase as well as at the time of sales. Then we have to do a computation. Right. Let's go ahead and do this. Just a minute once again. My screen has gone. I'll again share it. Just give me a minute. I hope you are able to see my screen. Please let me know if you are not able to. Yeah.
So okay. Only PPT we are able to see.
Yeah. We'll read the PPT, then we'll go to Excel. We'll read the PPT first, then we'll go to Excel. Right. It says, compute the long-term capital gain, or in case you have got the loss, we will compute the loss on transfer of listed securities where STT has been paid both at the time of purchase as well as at the time of transfer. That is the time of acquisition as well as at the time of transfer. In 4 independent cases. So we have got name of the company, we have got number of shares, date of acquisition per share. This is all per share. So it has to be multiplied by 1000. After we have finished this, we have to multiply by 1000. Then cost of this is date of sale. Ideally, this is not cost of acquisition. This is cost of acquisition. This is selling price. This is fair market value as on 1st January, 31st January 2018. Just give me a minute. Right. I think this should be date of sale. This column should be date of sale. It is wrongly given as Cost of acquisition. This column that I am telling you should be date of sale. Anyway, let's go and understand one point where we have to be very careful here. This is what a long-term capital gain. How do we know it is a long-term capital gain? They are very clearly given. This is listed shares. Listed shares. Listed shares na financial asset. Financial asset, what is the holding period? 12 months will be the holding period. 12 months will be the holding period. For the financial asset, the holding period will be 12 months. Right? Now, see here. It was all acquired. It was all acquired somewhere in 2016. And it is all sold in 2018. So that means it is held for more than 12 months. See, first case, December 2016, May 2018, more than 12 months. November 16, June 18, more than 12 months. January 17, July 18, more than 12 months. January 17, again, August 18, all are more than 12 months. Therefore, it will be long term. Long term. Now, how do we compute the long term? Section 112. 112, how do you compute? You will take full value of consideration. From there, you will reduce the cost of acquisition. Full value of consideration you will take. From there, you will reduce the cost of acquisition. Long term only, but still no indexation. Please understand very carefully. Section 112. 112A, you will not be eligible for indexation. Long term only, but still you will not be eligible for indexation. 112A, because 112A very clearly states you will not be eligible for indexation. Therefore, you cannot claim indexation. Now, if it is purchased before 31st January 2018, I'll not say before, we can say before 1st February 2018. Right? Purchase before 1st February 2018, then cost of acquisition has to be specially computed under section 55. Section 55 gives you separate kind of computation. Separate kind of computation. How will you do this computation? Two-step approach you have to follow. Two-step approach you have to follow. It is available here. Cost of acquisition. Cost of acquisition would be, you have to follow two-step approach. I hope you are able to see my PPT here. It will be, I'll see it, I'll show it here itself. First step would be comparing the fair market value as on 31st January 2018, comparing that with selling price, SP or selling price, whichever is higher. Then step 1 will be compared with the cost of acquisition. Sorry. Fair market value or selling price, whichever is lower. Then step 1, compare with the cost of purchase price, whichever is higher. So whatever you get in this will be the cost of acquisition. Then if it is purchased before 1st February 2018. So there are 4 cases. Let's see all the 4 cases when it was purchased. All were purchased before 1st February 2018. So how do you need to do? You have to compute. You have to take up fair market value as on 31st January. They are given fair market value as on 31st January. Compare that with selling price, whichever is lower. That is step 1. Then compare that with the purchase price, whichever is higher. That would be considered. See, I am just highlighting. So take the fair market value. I hope you are able to see the red colored dot that I am showing it to you. So take the fair market value, compare that with the selling price, whichever is lower. You will get one number. That will be step 1. From step 1, compare with the cost of acquisition, whichever is higher. That would give you the cost of acquisition. Now, this cost of acquisition will be reduced from the selling price to arrive at long-term capital gain. No indexation would be available. Let's read what is given here. For the purpose of computing long-term capital gain chargeable under section 112A, cost of acquisition in relation to a long-term capital gain acquired before 1st February 2018 shall be higher of the following: cost of acquisition and lower of fair market value and full value of consideration. Full value of consideration. Right. So in short, it is cost of acquisition of the long-term capital gain acquired on or before will be the actual cost. However, if the actual cost is less than the fair market value, then the fair market value will be deemed to be the actual consideration. Whatever you have discussed, it's again given. Further, if the full value of consideration is less than the full value of consideration is less than the fair market value, then full value of consideration or actual cost, whichever is higher, will be deemed to be. This is what we discussed. This is what we discussed. In 4 independent cases, the shares are long-term capital asset since they are held for more than 12 months. Preceding the date of transfer, it was held. Long-term capital gain paid. Long-term capital gain on transfer of STT would be computed as follows. Right. First, we will finish off the discussion. Then we will see what is there in the PPT. Right. Let's go to this discussion. Case 1. Case 1 is for Ganesh. Case 1 Ganesh. Right. Full value of consideration. Full value of consideration is 2,500 multiplied by 1,000. What is the 1,000? Number of shares. 2,500 per share. Clearly given here. So it is 2,500 multiplied by 1,000. Just put comma. Just give me a minute. 25 lakhs. 2,500 multiplied by 1,000 will give you 25 lakhs. Then cost of acquisition. How do you compute the cost of acquisition? Step 1. Fair market value or selling price, whichever is lower. Fair market value or selling price, whichever is lower. These two you will compare, whichever is lower. So you will have 2,500. Then that would be compared with the actual cost. Step 2. 2,500 would be compared with actual cost. Whichever is higher, you will again have 2,500. You will again have 2,500. Now, just 1 minute, friend. Nitesh, there is some error that we have got here. I'll just proceed with this. There is some error in the answer that we have got. Okay, I'll just proceed with the question. Right. Now, so it is 2,500. Again, I'll repeat with the steps so that we are all on the same page. There is some error in the answer, but anyway, we'll go with this. So step 1 is comparing 3,000 or 2,500, whichever is lower, so you get 2,500. Step 2 would be comparing 2,500 with 1,000, whichever is higher, whichever is higher. Therefore, you will again get 2,500. So cost of acquisition would be 2,500 multiplied by 1,000. What is the 1,000? Number of shares. So you will have 25 lakhs minus 25 lakhs. So there will be no long-term capital gain. There will be no long-term capital gain. Right. Now, let's go to question number 2. Question number 2 is in the case of Rajesh. Case 2, Rajesh. Full value of consideration. Full value of consideration is how much? Again, here also it is 2,500 multiplied by 2,000. Which is 50 lakhs. 2,500 multiplied by 2,000. What is 2,000? Number of shares. Number of shares. Then we will now compute cost of acquisition. Step 1. Step 1 would be again 2,500 compare with 6,500. Whichever is lower. So you'll end up having 2,500. This 2,500 would be compared with 3,000, whichever is higher. So you will have step 2. 3000. Right. 2500 and 3000, whichever is higher. So you will have 3000 multiplied by number of shares. The number of shares is 2000. So you'll have 60 lakhs. Therefore, we will end up having long-term capital loss of 10 lakhs. Long-term capital loss of 10 lakhs. Right? Now, Sridhar. Third case is Sridhar. Case 3, Sridhar. Full value of consideration. Right. How much? 3000 multiplied by 3000. 3000 multiplied by 3000. What is 3000? Number of shares. Again, cost of acquisition. Step 1. Comparing what and what? Selling price and the fair market value. Whichever is lower. 3000 and 6500. Whichever is lower, you will have 3000. Step 2. Comparing 3000 and 2000. Comparing 3000 and 2000. Whichever is higher. First step is whichever is lower, you get 3000. Second step, whichever is higher, you will again get only 3000. So, step 2 is what we have got cost of acquisition 3000 multiply by number of shares. How much number of shares? 3000. So, even in this case, there will not be any capital gains. Long-term capital gains will be 0. Then, case 4. Case 4 is 5. Full value of consideration will be 3000 into 4000. 3000 is the selling price, 4000 is the number of shares. It is 3000 into 4000. You will get 1 crore 20 lakhs. You will get 1 crore 20 lakhs. Cost of acquisition. Step 1. Cost of acquisition. Step 1. Now, it will be 6000 or 3000, whichever is lower. So you get 3000. Then, step 2. 3000 or 4000, whichever is higher. So you get 4000. Now, 4000 into number of shares, 4000. Now, you will again end up having in this case a long-term capital loss. 40 lakhs of long-term capital loss. Right.